Okay, accounting 2 kiddos, hang on to your seats. We are diving into chapter 21, which is accruals and deferrals, which, if I'm being honest, are probably some of the trickiest things to wrap our heads around in accounting 2. So bear with me. We're going to do the best we can, and we're going to tackle some accruals. It's a really fun word to say, actually, accruals, in our first section. 21-1. So you can see we have lots of objectives today, talking about what a reversing entry is, recording several reversing and adjusting entries, calculating accrued interest expense, all sorts of good stuff. So let's dive in. So one thing that we know for sure, and should because it's been something we've talked about several times throughout Accounting 1 and Accounting 2, is that GAAP requires us to record revenue and expenses in the accounting periods in which they are earned. So revenue gets recorded in the accounting period that it's earned, whether that's a year or a month. Same thing with expenses. But what we know is that sometimes things happen in one accounting period and then they transfer over to the next accounting period. And that's where accruals and deferrals run into some issues. So let's take a look at what that's going to look like. So first off, let's talk about an accrual. An accrual is an entry recording revenue before the cash is actually received, or an expense before the cash is actually paid. That's called an accrual. Examples of these are where interest income, remember, is earned each day, but it's recorded only when the interest is actually received. So when you think about this, if we have something invested somewhere and we are earning interest on it every single day, but we might not actually record that interest until we actually get the payment of it. Same thing with a note payable, where it might incur interest expense each day that we have a note outstanding, but that interest might not be paid until the note's maturity date. So what that looks like here is that it gets recorded, the revenue and expense gets recorded at the end of the period. However, cash doesn't get received until a future period. That's called an accrual. On the flip side of things, we have deferrals. Deferrals are where an entry is made recording the receipt of cash before that revenue is actually earned, or the payment of cash before that expense is actually incurred. We call that a deferral. Some examples of this is where rental income, you might receive a rent check in the beginning of May, and rent expense isn't actually, or that income isn't actually earned until that full month passes. So you get paid before the income actually happens. Same thing with the expense. You pay it at the beginning of the month, but it covers the entire expense, and we don't record that till the end. So that's called a deferral. So when we look here, cash is recorded when it's received or paid, but that revenue or expense actually gets recorded in the future. That's called a deferral. Now, if you remember, section 21-1, we're only going to talk about accruals. We're going to talk about deferrals in our next section, so just hang on for a little bit, but we wanted to kind of explain the concept between the two, accruals and deferrals. So let's go ahead and look here, talking about something called a reversing entry. Now, a reversing entry is an entry that gets made at the beginning of one fiscal period to reverse an adjusting entry that was made the previous fiscal period. So we've talked about adjusting entries before. We've done lots of them. We know that we always do those at the end of fiscal periods. However, what's happening here is that a reversing entry is the opposite of an adjusting entry. And I'll show you the reason why that's so important here as we look at an example. So our company on December 31st had a note receivable on hand of 90 days, 7%, $15,000 note that it was dated November 1st. So we signed it into effect on November 1st. December 31st is the end of our fiscal period, and we made an adjusting entry for that accrued interest of $175. You did that back in chapter 18, so that should look relatively familiar. Your adjusting entry, remember, is where interest receivable is debited and interest income is credited. Okay, we've done that before. But where the problem lies is that we had this note that was happening in one fiscal period, and now we're into a new fiscal period, and we remember we haven't actually received that interest income yet. And what happens is, if you remember doing closing entries, we get to the end of the fiscal period, we close all of our income statement accounts that have debit and credit balances. We want to bring everything back to zero, right? So interest income gets closed, and our interest income is debited for $2,512.80 to reduce that balance down to zero. So that's what this looks like right here with our interest income, okay? So we had that adjustment that we did of 175. That'll total $2,512.80, and so you can see we credit that, right? We go back to zero. And then interest receivable, remember that's the opposite of this one. It's at 175, okay? So what happens here, the adjusting entry it doesn't just stop at the end of the fiscal period. Remember, it's actually affecting things that are going to happen in the next fiscal period, because remember, our maturity date was for 90 days. So even though we signed it in, say, 2018, we're not going to receive that until 2019. So when we get to the maturity date 90 days later, our note receivable, the total interest we're going to receive from that is actually $262.50. But remember that our adjusting entry was actually made to record a portion of that, or that 175, the previous year. So what that means is that 175 of our total interest has already been recorded as revenue, even though we haven't received it yet. That remaining 8750 will be earned during our next fiscal period. So if you want to think 2018 and then 2019, 175 got earned in 2018. 8750 is going to be earned in 2019. Okay. Now, it gets really inconvenient for us to try to determine how much, if any, of the amount of cash that we receive when our note is due relates to which interest. Okay, so to avoid that, what we end up doing is making a reversing entry. Okay, and all that does is it reverses our adjusting entry. It's exactly the opposite of it. Okay, so like when we did our adjusting entry, it was a debit to interest receivable and a credit to interest income. The reversing entry essentially flips it. It's just a reverse of that. So what happens is interest income gets credited and interest income gets debited and interest receivable gets credited. Okay. Notice that instead of writing adjusting entries, we put reversing entries. This is going to serve as our document number. We'll want to make sure that we remember that, especially for tests. Okay. Now, in the situation where our reversing entry for our situation creates a debit balance for interest income. Now, that's kind of funky because if you remember, interest income is a revenue account, which means it increases on the credit side. So we're actually creating a debit balance for that, which is very strange. Okay, and that's where some people get kind of confused that how can we have an income account that has a debit balance? Well, remember that when the full amount of interest that's actually received, when we get to that point, we receive $262.50. It's going to be credited to interest income, which is going to result in that balance of $87.50. Remember, here's our total interest, $262.50, and we subtract out the $175. That's going to be our balance, our credit balance in our interest income. Now, we're not actually ever going to do T accounts like this, but it's important that you understand how those numbers are getting there and where those numbers are coming from. On the flip side of that transaction, it actually reverses our interest receivable to zero. So remember, interest receivable is interest that we have earned but haven't received yet. So because of the fact that we're going to reduce that down to zero, because when it gets to the maturity date, we'll actually have that paid in full. So when the interest is received, there isn't going to be an interest made to interest receivable because we're already receiving it. We don't need to record that. Instead, that total amount of interest will be credited to interest income. So I know that it's a lot to kind of digest, but let's take a look at what that looks like. So on January 30th, we received cash for the maturity value of that 90-day 7% note for $15,000 plus our interest for a total of $2,062.50. Okay, so cash is going up. That's the amount we're receiving total. Okay, our notes receivable is going down. That's our original principal of $15,000. And then our interest income is being credited for $262.50, which will give us our new balance. Remember that $87.50 we just talked about here. So again, that total interest of $262.50 was earned during the 2 fiscal periods. Okay, that $175 during the previous year and $87.50 during this year. The reversing entry, remember, this one right here, January 1st reversing entry, created a debit balance in interest income right there. Okay, after that $262.50 is posted right here, our interest income has a credit balance of $87.50, the amount of interest that's going to be earned during this current fiscal period. And note that our receivable balance, again, goes down to 0. So, of course, we can't see all of this until we post, but we want you to be aware of how these things are affecting, how these transactions are affecting each one as we go. Okay, and so here's the actual transaction, what that looks like when we record it in our cash receipts journal. We have our receipt number 948. Notes receivable gets credited for the face value. Interest income gets credited for the total, which is $262.50, and our cash is debited for $15,262.50. So you wouldn't actually see what's happening right now with interest income if we hadn't looked at all of the previous things we just did. So that's what is so important about understanding how is interest income ending up at the balance that it is. Okay. Now, we also have expenses that are incurred in one fiscal period but are not paid until a later fiscal period, and we call those accrued expenses. Now, at the end of a fiscal period, an accrued expense is recorded by an adjusting entry. We know that we've done that. That's like depreciation expense. That's a common one that we do. So typically what happens is we have an adjusting entry and it increases an expense account and it also increases a payable account because remember we haven't paid it yet. Okay. Interest incurred but not yet paid is an example of one of these. We call it incurred or accrued interest expense. So if we look here, for example, on December 31st, our company has one long-term note payable outstanding. So remember, this is us owing someone else money. Okay, you can see that our long-term note payable had the following terms. It was a 5-year note, 8% at 120 was the face value. And the terms of our note state that our company has to make a payment every month of $2,433.17. What happens is that payment is actually applied to the interest, and then any additional amount reduces our principal or the overall value. This is an example of like if you pay student loans, if you make a car payment, if you have a mortgage payment, this is exactly what's happening, is that you make a payment of $2,433, but that doesn't actually reduce your debt by that much. Some of it always goes to interest. And so this is exactly what we're doing here, is talking about accrued interest expense. So after having, we signed it on April 1st, by the end of that year, December 31st, after making all of our payments, our balance of that note is down to $106,625.67, as shown by this balance right here. Okay. On December 31st, our company owes 30 days of accrued interest expense and has to make an adjusting entry for that amount. Now, if we look at that over here, we've done adjusting entries before. We know how to calculate those, right? And before our interest expense had a balance of that $17,636. You could see that back on the last slide here. I can back that up. Here's our interest expense sitting at that amount. Okay. And so that interest expense gets debited for $710.84. We've calculated that before. It's just interest expense for a month. Okay. And the credit to interest payable creates a $710 account balance there. That's how much is owed before we start our next fiscal period.